So what are the implications for the Reserve Bank and the path of interest rates here in Australia? Joining me now is Paul Bloxham, the Chief Economist for Australia and New Zealand at HSBC. Paul, thanks for your time. The job numbers this week, much stronger than expected. Some economists think the RBA could be cutting rates in February. What's your view?
We think that they're unlikely to cut interest rates in February, and the employment numbers that we got this week were a contributing factor to that view. We had that view beforehand, but they were, as you say, stronger than expected. I think for the jobs print that we got this week, we could say they were both strong and there are signs that the labour market may no longer be loosening, that it might now be tightening. So they were strong. Employment was stronger than expected. The employment to population ratio got to its highest level ever. The participation rate rose as well. And so all round, I think they were pretty decent numbers. But in addition to that, if you look into the detail, although the unemployment rate edged a little bit higher, which is true, it's still below the peak level it reached in July. So it reached 4.2 and it fell to 4 by December. So it's still very low as well, in the sense that it hasn't really risen very much over the past couple of years. 4% is a historically low unemployment rate. And then if you go into the detail, the underemployment rate has been falling and the youth unemployment rate have been falling. And these are two pretty timely indicators. They're the more cyclical parts of the labour force survey telling us that the labour market is tightening up. If it's tightening up, then it's not going to keep putting downward pressure on wages growth and inflation. And for this reason, we think the RBA is not likely to cut interest rates in February.
And how do you explain the fact that 56,000 jobs were created during the month, but the unemployment rate lifted?
Well, I mean, that's another sign that things are actually quite strong as well, oddly enough. When the unemployment rate rises, it doesn't normally give you that result. But yes, lots of jobs created, 56,000 jobs. But it turns out that there were a lot of labour workers available and more people entered the labour force, such that the participation rate got to its highest level on record. So, that's another sign of a strong labour market. Lots of job creation, but lots of workers available to meet that demand.
So in other words, big population growth, lots of migrants coming to Australia, and they seem to be finding work.
Well, that's part of the story. I mean, it's not just the migrants coming in and being workers. It's also the domestic population. So, when you've got a participation rate that it's its highest level ever, I think you've really got, a pretty positive story in terms of the overall labour market.
The Reserve Bank last year in November put out their statement of monetary policy. They think unemployment will get to 4.5% by the end of this year. Do you think the true level of full employment in our economy could actually be a bit lower than that?
Well, so the RBA in their statement, as you say, estimated and told us that their working assumption as of November was that full employment in the Australian economy is 4.5%. And look, it's one of those things that you estimate rather than can observe. So, there could be some wriggle room in this number. But at the moment, the unemployment rate is 4%. So you are markedly below what the RBA thinks is full employment in the economy, which means you're at least at full employment, if not beyond full employment. Now, with that in mind, it's sort of hard-pressed to believe that the RBA is going to look at these employment numbers and say, hey, we're worried about the labour market. In fact, their worry will be, I suspect, that because it's so tight, you won't continue to get enough of a downward pressure on wages to get inflation to continue to fall back to the RBA's target.
And yeah, just give our viewers a sense of the significance of full employment, because it's really the level which can sustain employment and without stoking wages or inflation too heavily, correct?
So that's right. So economists talk about something called the NAIRU, and this is, or full employment, or the natural rate of unemployment, if you like. And it's an estimate. It's not something that you can observe, but you estimate the point at which the labour market is fully employed. And at that point, you're no longer putting upward pressure or downward pressure on wages growth in the economy. And so, the RBA is saying that full employment is still actually above the number for the unemployment rate that's in line with that full employment story is above where we currently are. We are operating still with an economy that is operating beyond its full capacity on that assessment. Now, I think you can look at other measures as well, things like capacity utilisation, and say, well, actually most of the metrics are still above their average as well. So I would say, it's fairly clear the Australian economy is still operating at about its full capacity. And with that, the question, of course, is why would you cut interest rates at this point?
Well, the RBA meets for the first time in February. They will see the December quarter CPI figures before that meeting. Do you think we'll see inflation fall within the trim mean inflation fall within the target band for the Reserve Bank during the last 3 months of last year?
Well, I don't think the trim mean is going to get back into the target band on a year-on-year basis. And that's the thing to really watch here. I think we're still going to have a trim mean that's running at 3 point something. It'll be above the top edge of the Reserve Bank's target band. However, I mean, and this is where the big discussion is, it may surprise the RBA a little bit to the downside relative to their own forecast. They were forecasting 3.4. It may turn out to be a bit lower than that. And that's where the discussion becomes about, could they consider, if they get a downside surprise to their own forecast on inflation, that they should think about cutting interest rates in February. That's why it's a point of discussion. But my view would be that you would still look at that and say, well, underlying inflation is still above your target. It's still above the RBA's target. And the labour market is strong, and it looks like the labour market is tightening. So I think that combination would make it hard to convince yourself that inflation's going to clearly get back to 2.5% on a sustainable basis, which is what the RBA needs to be convinced of. They need to be convinced not that inflation's heading to target, but actually that they're going to get back to 2.5% in a sustainable way. And I think the labour market numbers being as strong as they have been tells you that it's going to be hard for them to convince themselves of that.
And how much of an X factor is the new Trump administration, which starts next week in America, potentially putting new tariffs on global goods and stoking inflation around the world? Well,
this is a big question. And the big question is, firstly, when the Trump administration starts, what do they deliver? Do they deliver all the things that were listed out? Are there going to be large tariffs immediately delivered, or are they part of a set of negotiating tactics? Yes, they could potentially put upward pressure on global inflation, and that's potentially going to matter. For Australia, I think the key question is going to be, in response to whatever is done with US policy, what does China do in terms of its policies? Because, of course, that's our major trading partner. If you look at markets have been very, very closely trying to watch what's been going on in inflation and US inflation, and of course markets are factoring in some of those possibilities as well. And it's going to play a role also in what that global inflation story will play a role in how the RBA thinks about things as well. If it turns out that risk of global inflation starting to get into an upswing starts to play out, that's going to be another factor that might make the RBA a bit more reluctant to consider cutting interest rates anytime soon.
When they do, are they going to start cutting rates? That's the question.
Well, it is. It is a question, and I think it's one that we still have to, we still have to ask that question. Our central case is that we will get the RBA able to cut interest rates this year, that inflation will come down enough, and that the labour market will be just loose enough that the RBA will convince themselves, and they'll cut rates in the second quarter, and then we think in the fourth quarter as well. Now, the first point is, even if they cut rates, we don't think they're cutting rates very much, because keep in mind, inflation's been falling very slowly, and the economy is still operating at about full capacity, as we've already described. But as you point out, I think, and I've been sort of making this point quite vividly for the last few months, there's some risk here that inflation is falling so slowly and the labour market is so tight, and the global story might deliver the beginnings of an upswing in inflation. And if that were all to come together, then maybe the RBA doesn't get to cut interest rates in 2025. Maybe the RBA misses the easing phase because they didn't tighten as much, they didn't slow the economy as much, labour market's tight and inflation's falling very slowly.
Paul Bloxham, great to have you on the show.
Thank you.